Okay guys, and welcome back to the fourth video in this mini-series on the multiplier. And again, what we're trying to do is explain how an initial injection into the circular flow of income can have a bigger effect on national income, an effect on national income that is bigger than the injection itself. Okay, and again, I got this photograph from The Intelligent Economist. Okay, so what we're saying is the next factor that we have to take into account when analysing the multiplier is this idea of the marginal propensity to tax. And the definition, which you absolutely have to know, do not forget it, just learn it off. Marginal propensity to tax is the fraction of any extra income which is paid in taxes. If I earn an extra €1 and I'm required to pay an extra 10 cents in tax, my MPT is what? Well, it's the extra tax bill, the increase in my tax bill divided by the increase in income, which works out as 0.1. So what we have is the formula is just like the others, like the MPC and the MPS, is the change in taxes divided by the change in income. Okay, now looking at these questions again, and all I'm going to do is just be swapping between my camera, the document camera and the computer. So if you'd be kind enough to take a photo of that so you can refer to it as I'm working, but I will be flipping back and forth as always. Okay, so the first one is Andy earned an extra €50 and his tax liability increased by 20. Calculate his MPT. Okay, so now what I'm going to do is flip to this. Okay, so the change in tax was €20. The change in income was €50, and the MPT equals, well, I suppose the change in tax over the change in income, which equals 20 over 50, which equals, if you want, 2 over 5, which equals 0.4. Okay, we're just calculating that the idea that if that applied to the economy as a whole, any increase in income would cause an increase in tax of 40% of that income. That's the fraction of any extra income which is paid in taxes, which is required to be given in taxes. Aiden earned an extra 240 and his tax liability increased by 40. Okay, so what we're saying is that the tax liability, I'll put a line under this, the tax liability increased by 40 and his extra income, just let me check, was 240. Okay, was 240. Now what we've got here is 40, well, I'll write it again. MPT equals the change in the tax bill over the change in income, which equals 40 over 240, which equals 4 over 24. I believe that's 1 over 6, and you must forgive me now guys, I have to get the old calculator out. So 1 divided by 6 equals, and this is what I have here, if you can see, 1.666667. So what I'm just going to do is I'm just going to write it as equals 0.167. Okay, now you can get awkward numbers like that, but do not be worried. Okay, do not be worried with them whatsoever. You're far more, you're more than intelligent enough to work that stuff out. Paul's wages went from 500 to 600. Okay, so the first thing I'm going to do down here is the change in income equals 600 minus 500 equals an extra 100. So what we're saying is the change in income is €100. Okay, that's perfect. Okay, his tax liability went from 250 to 300 a week. Calculate his MPT. Okay, the change in tax equals, God almighty, I think it was 300 minus 250. You must forgive me, guys. Yes, okay, which equals €50. So therefore, the change in tax equals €50. The MPT equals the change in tax over the change in income, and what that equals is 50 over 100, or 5 over 10, which equals 0.5. What we're saying here is that the MPT in this question equals 0.5. If that was true for the entire economy, that would mean that any income that was earned, the government would take half of it in taxes. I want you to understand that taxes are a leakage. A leakage is going to reduce spending. The multiplier is talking about increases in spending beyond or above or greater than the initial injection. So any of these things like the MPS, if that's high or if it increases, the MPT, if that's high or more accurately if it increases, those two increasing in those two leakages as a margin will cause the multiplier to reduce. Okay? Now, Jonathan's wages went from 880 to 990 a week. So the first thing I'm going to do is put a line under that. I'm going to write down delta y, okay, and you can see that, equals 990 minus 880, which equals 110 euro, which means that the change in income is 110 euro. Okay, forgive my poor writing. Now, his tax liability increased from 440, it's 90, okay, from 440 to 530, okay, change in tax equals 530 minus 440, 60 and 30 is 90, so therefore what we're saying is that the change in tax equals 90 euro. So the MPT, and forgive me, I know you can't see that, so I'll bring this down, so the MPT equals the change in tax liability over the change in income, which equals 90 over 110, and the best I can do for you here, guys, is 9 over 11, and what is that? Okay, I was way off. 0.8181 blah blah blah. Okay, so I'm going to write down equals 0.82. Okay, and that's the MPT. Now that would be absolutely insane. Imagine, 82% of any extra income is taken by the government. Talk about a leakage. Okay, not a good idea, unless inflation was simply rampant, and that would still be their fault because they're the ones that are printing the money causing inflation. Okay, an economy's national income, on the fourth one down, where is it? There it is, this one here. An economy's national income went from 45 billion in 2012, God I'm old, to 50 billion in 2013. Okay, so what we're saying is, okay, the change in national income was 50 minus 45, which equals 5 billion. Okay, 5 billion euro. So that there is the delta y equals 5 billion. Okay. Now, in 2012, the government collected 20 billion in taxes, and in 2013, the government collected 23. Calculate the economy's MPT. Okay, so the change in tax as an economy as a whole was 23 minus 20, which equals 3 billion. So therefore, the change in taxes equals 3 billion euro. Now, the MPT, as always, equals the change in tax over the change in income, which equals 3 over 5, and I'm confident about this one, is 0.6. The MPT in this economy equals 0.6. Again, in my opinion, insanely high. Okay, and penalising those that are working, generating the wealth. Now, the last one, the economy national income. The economy's national income went from 497. My God, why did I choose these numbers? I think that's 16 to 513. Okay, so what we've got here is a line under this. Okay, the change in y equals 513 minus 497, which equals 16 billion. So what we're saying here is that the delta y, the change in income, equals 16, I know billion, but right now we're still working it out. Okay, and the government, in the first year the government collected 103, and the second year the government collected 117. Change in tax equals 117 minus 103, which equals 14 billion. Okay, billion euro. So therefore what we're saying is delta t equals 14. Well, that's also crazy. Okay, so the MPT equals the change in taxes over the change in income, which equals 14 over 16, which equals 7 over 8. And again, guys, you must forgive me, 7 divided by 8 equals, and I get 0.875, okay? So again, an absolutely crazy high MPT. Now, none of this is real. These are all just numbers from the top of my head, but still just kind of an incredible thought that imagine if every extra euro you earned, the government took 87.5 cents, okay? Very huge disruption to the incentive for production, which is, again, as we've always said, production is wealth because it causes consumption to rise. Guys, that's the end of it. I really hope that helps. Just keep on going through them. I know there's a lot of information, know the definitions. We're building up in the next video. We're going to add taxes into the formula, and we're going to see that they reduce it. Okay, so keep that in mind, that everything but the MPC is simply a leakage, and leakages will reduce the multiplier. Thanks so much, and hope to see you in the next video.